Welcome to the daily update, where I'll go over the action in the market for Thursday, September 5th, and then we'll see how things look for Friday, September 6th. We have now turned negative officially. Now, we've got the big employment situation report coming out in Friday's session. Could the market recover from that? Of course. But we are shifting over. Our indicators in the short and intermediate term have now pretty much gone over to the negative side. So that's the side we're focusing on for right now. If we get some kind of a positive reaction to the report, of course, that could shift things back. But we just look at what we see right now and have to make an evaluation based on that. Okay, so please feel free to check out the SPX Investing Program. There's a link below this video that will take you to the website. There's also a link that will take you to a video that you can watch about that. You do get early access to the daily videos and the weekly videos if you find them helpful to you. Also, the daily video, that's the real hub of the analysis that I do. All the other videos are prepared on a weekly basis, and they're meant to tie into the daily video. All right, let's go back and talk about what happened. We did have a higher open, and prices almost got up to R1 at 55.47, but that ended up setting the high for the day. And prices declined down below the daily pivot at 55.26. We got below the unchanged level. We got down to S1 at 54.98. So we broke below that 5,500 level, and we found support slightly above S2 at 54.76. Then prices tried to climb, but hit resistance at the unchanged level, and that's a built-in resistance level on a down day or support on an up day. And we closed pretty much at S1. We were down 0.3%, not a real huge move, but we were down nonetheless. And volume is still below average. There's a lot of hedging going on ahead of Friday's report. Volume is below average. Folks are waiting to see, is this going to shed any light on the current situation? What's going to be frustrating is if the report comes out mixed. It's like higher than expected in one area, lower than expected in another, and right at expectations with another area. And the market's not quite sure what to dwell on with that. So we are now negative in the short and intermediate term, but we're hanging out at support levels with other indexes. And I'll show you those charts as we go through them. We're going to see if things will change as far as inflation and interest rate, the whole scenario that we've been working with the employment situation report. This is what the market has been waiting for. I saw one interesting post on Twitter that said the non-farm payroll, it's the most important economic report since the fall of the Roman Empire. Well, I mean, it's just, they say that this election is the most important election ever. It should always be that way. Whatever you're dealing with right now is always the most important. The next test you're taking, every day should be the most important day. But it's kind of interesting how people like to qualify different days as being more important than others and different times. But yeah, this is pretty important. We'll see if it changes the overall scenario. And some comments. We did close down below the 20 and 50 simple moving averages. Now we're still hanging out at the exponential moving average. I'll show you that chart where the NASDAQ was actually positive on the day. Not by much, but it did see an up day. Mega caps showed a little bit of life in Thursday's session. Oil is still below that 70 level, and the VIX is still below 20. Even though we had a down day with the S&P, the VIX actually declined a little bit. And the 20 and 50s, they had been providing support. You could still kind of loosely say that because now we're switching over to the exponential moving averages. So we kind of look at that we haven't really cleared those areas yet. And the mass index, it does look like for right now, at least what it's picking up is that we were due for some kind of a pullback or a reversal after we had been going higher. That seems to be playing out, at least to this point. We're still extreme with the slope oscillator, but I have the asterisk here because it's below its moving average, and one of our stochastics charts are still extreme positive. And we're already extreme negative with the Stoke RSI, Williams percent, or CCI 14, and the stochastics. Nothing was added or taken away from this list from yesterday's video. We're still coming down and looking more negative with the TTM squeeze, but it's still giving a very high reading. And we're also declining, but extreme positive with the 10-day moving average of the highs and the lows for the S&P. And the 150 is now dropped off, but we're still looking extreme with the 200 period simple moving average. So we'll see if anything comes out in Friday's session to actually change this scenario. The Fed is going to cut rates here coming up on September 18th. We just don't know how much, either 0.25% or 0.5%. The dollar was down, interest rates were also down. We keep following with that 10-year yield. We're at 3.73%, where we had been at 3.77% after Thursday or Wednesday's session. And we're still inverted with the yield curves. We're getting very close with the 10 to the 2. If this report comes out and it's kind of the scenario that maybe the employment situation is deteriorating more than anticipated, we'll likely see the 10 to the 2 go back to being uninverted or going back to being normal. And that feeds more into the once the yield curves are no longer inverted, stocks are going to crash after that. Well, we don't know if that's actually what's going to play out, but we just watch these things unfold and look at lots of different areas to bring together this consensus conclusion. Sentiment is still going down. We had been at 53 where we were positive. Well, we were on the upper side of neutral. We're still neutral, but now we're dropping below that 50 level at 47. And we're still not trending, but we are negative. The ADX continues to fall. The red line is above the green line, so that's why we default to negative. And the bias is still negative because we had a down day. And I've switched our momentum to negative now. It's looking a little more established over the last number of trading sessions, especially this past week. So the economic reports that came out, this was weaker than expected, quite a bit weaker than expected. The ADP employment change came in at 99,000. They expected 150,000. Last time it was at 111,000. The jobless claims, these came in actually better than expected. They expected 236,000, 227,000 came out. So fewer people filed for unemployment than what they thought. Last time it was at 232,000. And we're seeing a little bit of a tick down here with the continuing claims at 1.838 million, where it had been at 1.86 million. Second quarter productivity, the revised number came in at 2.5%, more than the 2.3% that they had expected and up from the 2.3% we saw last time. So productivity is actually ticking up. But we look at the next one, unit labor costs are actually coming down. It's less than expected. It came in up 0.4%. So it's still going up, but they expected it to be up 0.9% as it was last time. And the global services PMI, the takeaway from this is that we're above 50. We came in at 55.7, where we had been at 55 with the preliminary reading. This is the other big one, the non-manufacturing, the ISM. It came in above 50 at 51.5. That was greater than expected, where they thought it was going to come in at 51. Last time it was at 51.4. So again, showing some expansion in the economy when we're looking at services. So here's the chart. And the takeaway from this is the weekly jobless claims are declining and the 4-week moving average is also declining. This shouldn't be happening if the unemployment or the employment situation is beginning to fall apart. We would see both these lines going up, and that's just not happening right now. We're also seeing the continuing claims starting to trail off and the moving average is now starting to roll over. Again, what we would not see if things were falling apart with the employment situation. So we'll get an update on the unemployment rate in Friday's session. We are seeing a decline with the continuing claims in blue and the initial claims in red. And we're seeing a real drop off here. So this is a little bit of the weaker part of the equation where we're coming down with the ADP employment change. We're still positive, but it is declining. And we look at the productivity, which is the blue line. It's actually rolling over a little bit on a year-over-year basis. But from the report that we just saw, it actually went up. and the unit labor costs are coming down too. So the fact that especially the yellow line is coming down, that is helping more of the inflationary aspect of this report. And then we look at the ISM services, where the total, we are above 50, and we did tick up a little bit here, and the prices are going up. So this is actually a little bit inflationary. All right, then looking at this, and feel free to pause this and look this over. Basically, this is kind of what I've been saying from time to time. When I first started in this decades ago in the early to mid 90s, the Fed used to follow the stock market. Well, ever since we had the great financial crisis, it's kind of reversed the roles here. And now it's like the market follows the Fed. And that's really not how it's supposed to work, but it's how things have developed. And this chart just kind of points that out, that what the Fed does has more of an impact on what happens in the stock market. Okay, buybacks. Still seeing a lot of buybacks, but they are dropping off from the real high readings that we saw in early summer. And then this is, I'll show this chart again later, but this actually includes the times that we've had a recession. We're getting really close to the 10 to the 2-year yield curve, going back to no longer being inverted. We're really, really close right now. We've been close now pretty much all week. And then by sector, what are the inflows and outflows that we're seeing right now? Seeing a lot of money coming out of the market as folks are getting a little more apprehensive, but money's actually been going into communication, but we're seeing a lot of money coming out of all these other sectors, except, well, we're seeing money coming out of tech. So really, communication is where we're seeing some inflows based on this chart. And then this is looking at the cumulative consensus GDP. And this is positive for the economy because we're still showing that the US economy is leading things. When they revise GDP, they tend to revise it up, and they revise it up in the EU, where they've been pretty much revising it down in China. And then comparing stocks with commodities, and I go over this again in the intermarket analysis video over the weekend. This just shows how stocks are going up compared to commodities. And then it says from a 2% world to a 5% world. This is just looking how inflation has really gone up, even though we're trying to come back down to that level on a year-over-year basis. This goes all the way back to 1900 to see where inflation was at certain times. And then the Fed funds rate, surprise relative to market pricing at the start of the blackout. This is when the Fed officials can't make speeches and they don't do interviews and things like that. And this is realized surprise and Fed funds rate. And then the pricing at the start of the blackout, it usually ends up going down here on this chart. Then just one chart that I found from Sentiment Trader, and this confirms what we've been seeing in these videos, where the market is becoming more defensive. We've been watching these defensive sectors, and this shows how they've been performing. When you look at those different defensive areas, this is just measured in a little bit different way. And this tends to be more negative for the market. When the market's becoming more defensive, you can see we're seeing pretty high readings here right at the end of 2021, and then we ended up going into 2022. Now, we don't know how long this is going to last. We don't know if it's going to go very deep. Of course, the perma bears say that the stock market's pretty much finished now. And the perma bulls think, well, this is just buy the dips, buy the dips. Well, we have to be realistic about this and realize that there are times when the market goes down. And based on what we're seeing right now, it looks like it could get worse. Of course, that could always switch back and we could look more positive. But we've been drifting over to this side of actually looking more negative as we go into a weak seasonal time for stocks. Okay, here is the intraday chart. We did have a higher open. We just about got up to R1 here, but that was the high for the day. We came down, fell below the daily pivot, fell below the unchanged level, fell down below S1. And I was putting some posts on the website at this time as we were breaking below, because you can see the lows that we set on Tuesday and Wednesday. That was the 50-period moving average. Well, then we broke below that. And then I put another post up saying, well, be a little careful of this, because sometimes what can happen is people see this and people are day traders, or they're look at these charts and they say, okay, here's the low for Tuesday, here's the low for Wednesday. I'm going to put a stop loss order right under the low for Tuesday and Wednesday. And then that's sometimes why you see this real big move down. It's all those stop loss orders being triggered. And then what trick can play sometimes is to come down, wipe out the orders, and then things turn around and go back up. Well, we stabilized, and we tried to go back up here, but it really wasn't leading to much of anything. And we ended up closing just a little bit above S1. Here's the intraday chart. Not a real big change in the initial overnight session as the market anticipates the employment situation report coming out. This is still causing us a concern, even though the red line and the blue line are going down. The red line above the blue line is not what we want to see in real solid environments. And we did see a little bit of improvement here with the growth to value ratio intraday for the S&P, where it has been declining. That's been putting some pressure on the S&P. We flattened out a little bit here. We need to see this go back up and see more of a trend across multiple days to turn back more positive. If this continues to fall, that of course would turn things more negative. All right, so we were up with growth where value was down. So growth ended up doing pretty well, but not really changing the overall scenario that we've been dealing with. Growth was down, but less with the mid caps, but it was down more with the small caps. So we're ticking back up. It's still declining with small cap growth to value. Mid cap growth to value continues to decline. Ticked up, but still declining with S&P growth to value on our end of day charts. And we're coming back up a little bit, but we're still below the rainbow when we look at the growth to value ETFs. And coming back down after we had been coming up with the discretionary to staples ratio, this is still showing some more weakness. Large cap growth still hanging out above its 100-day moving average. Now we have fallen below the 50, and that's a concern. But the fact that this level is still holding up is more positive for the large caps. Our trend shows that we're still declining with the ADX. We're still below the moving average. The red line's on top, and now it's starting to go back up. So we look at this as a non-trending, weakening trend environment, but it is negative. We're also starting to turn back up here in the short term. If we get a down day on Friday, we could start to turn up and possibly even cross above the moving average with the ADX, and the red line could continue to go up. And we're still below average with volume after we had seen a couple of days of above average volume. And I put this back up because the Ulcer Index is starting to go back up. We're getting near the moving average here as fear is increasing. We actually came down a little bit, even with the slight down, Dave, and with the S&P looking more negative for a lot of the day. The VIX declined, and we're just a little bit under 20, both with the closing line chart here, or with the line, and also with the bar chart. Okay. And we came down just a little bit with the VIX of the VIX as well. But the momentum of the VIX is continuing to go up as measured by the MACD. And this is that seasonal time when, so far, what appears to be playing out may have started a little early, but this is not uncommon to see September and October have real struggles with the VIX going up because stocks are going down. Skew index still giving us a reading. The market may be setting up for Friday's employment situation report. We've spent most of the week now up in this red area, and it did decline a little bit in Thursday's session, but we're still getting a fairly high reading here. So the market is still anticipating something big to happen. And we declined with this fear gauge where we're going up with the other fear gauge. So a little bit of a contradiction there. We want to keep an eye on the spread between risky and not as risky bonds. It's more evident in this chart. When this is going down, that means the risk is increasing. We had been coming back up after the down day that we saw in early August. It was looking a little bit better, but now we're starting to see some more risk emerge here. We did get the latest reading from Investors Intelligence. They came in at 2.41, more neutral from the latest reading. And coming down just a little bit, not getting really extreme, are the American Association of Individual Investors. Still looking kind of positive overall, but not extreme positive. We're still tending to go down, even though we ticked up slightly with the risk on to risk off ratio. That's because the mega caps had a okay day. But look at this, the daily chart for the equity put call ratio really spiked up as folks are hedging ahead of the report. So we're going up with the 5-day. We're also continuing to go up with the 10-day put call ratio chart. Coming back up, it's still in the band here with the volatility risk premium. So we're seeing a lot of potential hedging and some concern ahead of this report. And that's because it's a really important economic report, especially this time. We did decline, but we're still looking okay with the advanced decline line based on price, also declining based on volume here, but we're still above the moving averages, and the moving averages are going up. We're still hanging in there fairly well. We dropped off with the new highs, saw a little bit of an expansion of the new lows. So this internal measure is still hanging in there fairly well. We are rolling over with the 5-day, and we're starting to top out and turn back down with the 10-day. We're declining, but still positive with the advanced decline ratio. This breaks that out based on price. We're declining, but still positive. Declining with a little bit more enthusiasm here with the volume. And still coming down, but looking positive with the 10-day average of the S&P 500 highs minus the lows. That's longer term and still suggesting good momentum, more in the intermediate term here. And we're still going up with our 50-day new highs, new lows for the S&P. And we're starting to potentially turn negative here. Accumulation distribution is starting to come down to the moving average. Based on the boom indicator, it's already dropped down below the moving average. But you can see right here, we're just about on the moving average. But this is interesting. The Chaikin money flow actually went up, even though the S&P went down. But the Chaikin oscillator has now confirmed itself negative. It's declining and below zero. So we're seeing a real mixed picture here with our smart money indicators. And we're turning negative with the vortex. The red line is crossing above the green line. And coming down, but not showing any real problems yet with the S&P advanced decline line for on a cumulative basis based on price. Seeing a little bit more enthusiasm here based on volume. And we're still hanging in there okay with the NYSE advanced decline line compared to the S&P 500. I mean, they're both declining, but we're not seeing any real divergence right now. And we look at the NYSE cumulative advanced decline line coming down to the moving average, a little bit below it right now, declining, but not really looking like it's falling apart with our regular advanced decline line. Also coming down with this other NYSE advanced decline line. And coming down with the common stock based on price, coming down based on volume. Actually seeing a little bit more enthusiasm here based on price, where with the S&P, we're seeing it more based on volume. This is still positive. The new highs minus the new lows for the NYSE coming down, but still positive here. Coming down, but still looking okay for the time being with our advanced decline line studies pretty much across the board. And we ticked up just a little bit with the large caps having a better day than the small caps. And then looking at our short-term charts, we are coming down below the 50-period simple moving average now. We did find some support just about at this pivot point, and we are below average with volume. And coming down with our 20, 50, and 200-period moving averages. Showing a little bit of deterioration here with the 20-period moving average study. The lines are starting to roll over. We're also dropping below both the simple and exponential moving averages here in the short term. So short term, we're definitely negative. And looks kind of, it can be hard to see some of these things, but we're camped out pretty much at the 50-day exponential moving average now. But we have fallen below the simple moving average, just barely. And the Stochh RSI is extreme negative, as is the Williams percent R. The CCI 14 is extreme. We're negative since we're dropping below the midpoint, but the CCI 20 is not extreme negative. And we're extreme negative in the short-term stochastic. We're negative in the intermediate term. We're still extreme positive, but rolling over in the long short-term stochastic. The force index continues to be negative now. We're dropping below the midpoint with our standard deviations chart. Coming down after getting that really high reading with the stocks above their 20-period moving averages. We're still above 50, but this is really declining. And coming down, actually dropping below 70 here. And declining, but still positive with the 50-day moving average. And the 100 is declining, but still positive. And the 200 is also declining, but still positive. And we're declining, but still above zero with the balance of power. So this is showing some more weakness. And we're dropping below the condition of our 50-period moving average here. We're below both lines. The lines are starting to roll over now, and we're a little bit below the simple moving average, and the low for the day was actually set at the exponential moving average. And we're turning to negative here with the go, no-go chart. We're coming down, but see how the red line's really coming up now with the lowest low value, where we're flattening out with the highest high value. So this chart is showing some weakness as well. We're coming down, and we have the darker blue. That's more negative, but we're still above this black line here, which means we're extreme positive. And this gives more of a context of how that's playing out. We're dropping negative now with the ease of movement. It's gone below zero. The Erin is just flat. And we're going negative with the S&P McClellan oscillator. We've dropped below zero. So we're starting to roll over based on price, and we've already been declining here based on volume. So now we're seeing more confirmation on the negative side now. And we're also turning negative. We've been slightly negative, but we're going down even more with the NYSE McClellan oscillator. So we're starting to roll over with the summation index based on price and volume. Declining, but still positive based on price. Actually ticked up a little bit with the Swenlin trading oscillator, but we're below zero. And momentum is starting to weaken as well. The PMO is rolling over. We're rolling over based on price. We're also rolling over based on volume. Declining with the PMOs that are rising. The buy signals are declining, and we're no longer extreme positive with the PMOs above zero. We are negative with the Elder's Impulse system for the S&P. We're negative with the parabolic SAR. We're still extreme positive with the slope oscillator, and we will be until we drop down below this green line, but we're below the moving average, so this is more negative. And the MACD is crossing below its moving average. That's negative in the short to intermediate term. So we're seeing some weakness across the board in the short, intermediate term, and we're rolling over in the longer term with our oscillators. The copy curve is now turned negative. The Sean trend meter is more neutral right now. And this is holding up. We did decline with the bullish percent index, but it's not falling apart, at least yet. We're declining, but still positive with the NYSE bullish percent index. We're turning negative now with the NASDAQ 100 bullish percent index. Declining, but still above 50 with the money flow, and below 50 and declining with the ultimate oscillator. That's negative. Starting to come down and drop below the moving average with unbalanced volume. And then we can see here, we're dropping a little bit below 50 with the 14 and the 9-period RSI. And if you look at this, where we set a high and then we were coming back up here, you could count this as a negative divergence, as we were making a lower high here with the RSI, both based on 14 and 9 periods. All right, and then the mass index, it looks like for the time being anyway, that this signal is valid. It was signaling a reversal as we were going up, and that's kind of how things have been playing out to this point. And the Pring bottom fisher still generating a buy signal, but starting to roll over. And we're coming down. We're still dealing with the 20-period moving averages here in this little mini rainbow. We're wondering if they will still provide support. If we fall down below that, that's going to turn the short term even more negative. And we're coming a little bit more into the cloud here with the Ichimoku cloud. The blue line's still above the red line, which is positive, but it is starting to roll over. And the green line, it's really hard to see that. It's kind of jumbled up in here with price, but it's starting to decline as well. Longer term, with the weekly chart of the S&P, we're still above this R2 level, even though we're down 2.5% so far for the week. And coming right back down to this 50% fib extension level with the SPY, and turning more negative here with the Heiken Ashi. That's negative with the dark candles. We're negative with the Kegi. Renko is still positive, and we're turning more negative with the 3-line break. And we had a couple of O's drawn in here. The positive signal that we were seeing has now gone away, and this is picking up the downward action for the time being anyway. And coming down with the 150, no longer extreme positive. We're declining, but still above this red line with the 200-period simple moving average. So we're still negative in the short term, positive in the intermediate and long term across all the stock indexes. We're negative with stocks in the short term, positive with bonds across the board, negative with commodities and the dollar across the board. We saw discretionary actually had a better day. It was the strongest area. That's been a disappointing area in 2024. It was up and communication was up, where all of the other sectors ended up being down, with healthcare more defensive. That was down the most. Saw a lot of Christmas tree type looks here with red and blue or green here. As we got later in the day, this is when the S&P fell below 5,500. We're seeing some weakness up in Canada, and the Nasdaq is also dropping below these psychological levels here. The materials did have a bearish MACD crossover, and the Dow, even though it just less than a week ago set an all-time high, it's now seeing a bearish MACD crossover. All right, and we're coming down with both the S&P and the equal weight S&P. That's coming off of setting recent all-time highs as well. And we're coming back up a little bit here with our ratio as the large caps had a little bit better day than the equal weight version. Coming down to this pivot point, and this is holding for right now with the Dow and still above its 50-day moving average, but we're negative with the Elder's Impulse system for the diamonds. And coming down to this pivot point now, we're dropping below the 50 with the NASDAQ, but we're still, of course, above the 200. We're wondering if this pivot point is actually going to provide some support. And also coming down to this pivot point with the NASDAQ 100, we are still negative with the QQQs, with the Elder's Impulse system. The momentum for the NASDAQ 100 is now negative. The Qs still dropping below both their 20 and 50 period moving averages. And kind of had a slight update here. That could be positive, but we're still well below this 23.6% fib extension level. And this is an interesting thing. The small caps came down to their 50-day moving average, and this appears to be providing support. We're just a little bit below the 50-day moving average here with the Russell 2000 small caps, but we're below 50 and declining with the RSI. The momentum has also turned negative. And we're negative with the Elder's Impulse system for the small caps. Mid caps dropping below their 50-day moving average, and negative with the Elder's Impulse system. This is a support level that's holding. This is the Wilshire 5000. We're right on the 50-day moving average. And we're right on the 50-day moving average with our total U.S. stock ETF. So broader market, we still have some support that's hanging in there. The staples to tech ratio is really going up as staples have been outperforming tech. And the financial sector, after really doing well, it pulled back over 1% on Thursday. And we did see a bounce up over 1% here with the FANG index, but we're still below the 50-day moving average. And we're dealing with this longer-term trend line here with the FANG index. So far, it's been able to stay above that. If we see some more weakness on Friday and break below that, that, of course, will turn things more negative. Apple was up 0.69% at its 50-day moving average, it's bouncing up off its 200-day moving average with Amazon. And Microsoft also is dealing with its 200-day moving average. Google with its 200-day moving average above the 50-day moving average with Meta. And NVIDIA was up 0.94%, kind of in between the moving averages right now. And Tesla's breaking out above its 50-day moving average. And that helped the discretionary sector to be one of the better areas. It was up 4.9%. Netflix was up 0.58% above its 50-day moving average. Then the broad market, 5-day moving average of the highs minus the lows, still coming down, but above zero. And we're seeing a little bit of an improvement here with the short-term correlation between U.S. stocks and world stocks, where the longer-term correlation is still holding steady. Oil continues to be below 70. The dollar continues to be in a downtrend, and we're breaking back below this trend line here on the longer-term chart. We're continuing to go down with the 10-year yield. We're going up with the 10-year based on price. Here is the 10 to the 2-year yield curve. We were at 0.01 after Wednesday. We're at minus 0.01. Now we're at minus 0.03 after Thursday. So we're getting very close. The Friday could be the deciding day to see if we stay inverted or go back to looking normal. And we're not really seeing much of an improvement here with our growth to value ratios. That's been the story lately with the Qs to S&P. Discretionary showing a bit of an improvement here, but large cap growth is underperforming large cap value. So we're going down, but seeing a little bit of improvement with the large caps. We're declining with the mid caps, ticking up, but still declining with the small caps. And the S&P to utilities ratio still continuing to go down. That's negative for the S&P. And the staples to S&P ratio continues to go up. That's also negative for the S&P. So what's our outlook? We are now negative with our technicals, but we're looking at those, especially the broader market. We have the small caps, we have the Wilshire, and we have that U.S. big US ETF stock. I don't know what to call it. They wish they'd come up with a name for it, like gargantuan or something. But those levels are holding for right now. So we're going to be watching those in Friday's session if we see more weakness. We're going to get the employment situation report here, and then we want to keep an eye on all the geopolitical things in case they impact the market. Here we'll be finishing out the economic calendar. Here's also the expectations of what should be coming out. And that's really what matters is the market has what the forecast is, what they think is going to come out. And then are we above or below that particular forecast? Seasonality, and have a new few charts here that I'll probably take out and put into the weekly video after this video here. September 6th, we're neutral to negative with the Dow, but we're neutral to positive with the S&P. So no real edge one way or the other there, slightly more positive. Here is an updated chart from Stock Traders Almanac. We do see a little bit of sideways to negative seasonality here for the S&P. That's the green dashed line. And then this is what has been happening so far in September. And Friday, based on 2023, is the second most positive day, where it's still a positive day based on what has been happening in 2024. We'll see if it can stay that way. And then the first part of September is okay, where it's the second part of September where things really start to fall apart. And then this is another newer chart here where September and October tend to be weaker times for the stock market. And then this is also from Stock Traders Almanac, where instead of just looking at the S&P, which is in blue, we also look at the NASDAQ, which is in black. And September and October can often be negative during an election year going back to 1950. And then these are charts I have been showing. September and then into October tend to be negative going back to 1928. And then this shows how September is negative, but then October can often be positive. This is also taking that 3-month period of time, going back to 1928 and showing how the returns are not very good during this period. This is looking at 2024, comparing it to 2023, where we had that downward move back in 2023. Are we going to play out with a similar scenario this time? And then comparing the non-presidential with presidential election years, we see weakness either way here, but usually a little bit more weakness when it is a presidential election year. And then we're split 50-50 here with the S&P in the month of September during an election year, but the return is down 0.4%. So the warning signs, we're keeping an eye on this, just like that sentiment trader chart. Staples and utilities, healthcare, these are areas that have been doing better and been holding up, and that tends to be more defensive for stocks when they get ready to decline. But we've been watching that for a while. The equity put call charts, the 5-day and the 10-day, are going up, and both the S&P and NYSE McClellan oscillators and summation index have now gone over negative. Parabolic SAR is negative. The oscillators, we haven't quite clicked over negative with the long term, but we're rolling over and turning negative in the short and intermediate term. The ease of movement, the momentum for the NASDAQ 100, as well as the bullish percent index, has now gone negative. The ultimate oscillator, the Copic curve, the vortex, that's another new addition here. It's crossed over negative. And even though we saw discretionary do okay on Thursday, we need to see a lot more than what we've seen. And growth did have a okay day compared to value, but we're not seeing any kind of a sustained trend there. So looking at the positive side, accumulation distribution, that could be getting ready to turn negative, but the Chaikin money flow went up, and that's still looking positive, where we have already turned negative here with the Chaikin oscillator. And the reason I have this on the positive side, I like to keep these three together because they are our smart money indicators. The advanced decline lines, even though they've been showing weakness, are still above their moving averages. The Swenlin trading oscillator, it's still positive but declining based on price, negative though based on volume, even though it ticked up a little bit. And the S&P and NYSE bullish percent indexes, those are holding up fairly well right now. The money flow in the financial sector saw some weakness, but it's still positive. So our conclusion, we're turning negative. Now, in the short term, we're already negative. We're trying to figure out, okay, are we going to break lower even more from here, or are we going to be able to bounce up with some of the support that we're seeing with the other indexes? So we are negative in the short term. We're also negative in the intermediate term unless we find some support. And we continue to be positive, though, in the long term. Thank you. I hope you found this helpful. I hope you have a good day. It'll be an exciting day to watch, I hope. It would be really disappointing if it ends up being a nothing burger and the report really doesn't clarify anything. So have a good day, and I will talk to you in the next video.